3 days ago. I told you this wasn't a crash. I told you it wasn't a bear market. I told you exactly what was coming. And today, gold surged $212 in less than 24 hours. Silver exploded 5.5% at the open. The largest IPO in the entire history of financial markets went live this morning. And the President of the United States announced that a war is now over. Every single thing I said would happen happened today, on the same day. But here's what nobody is telling you. The recovery you're watching right now, it's not the story. The story is what comes next. And what comes next could change everything. For gold, for silver, and for every serious investor watching this right now. Welcome to Currency Insight, the channel where the numbers do the talking and we do the translating. Now, before we go any further, if you haven't subscribed yet, I want you to think of it like this. You know that one relative, maybe an uncle, a father, a grandfather, somewhere past 50, who's seen every market cycle, every crash, every recovery, and always said, "I wish I had known sooner." Don't be that person. Hit that subscribe button right now and turn on the bell notification so the next time something this big is moving, you're the first to know, not the last. And while you're at it, drop a comment below. Where in the world are you watching from today? London, Lahore, Lagos, Los Angeles? Tell us. We read every single one. Now, let's get into it. 3 days ago, one analyst sat in front of a camera and made a very specific claim. He did not panic. He did not follow the crowd. While every major financial news outlet was running headlines about a bear market, while social media was flooded with fear, while investors were hitting the sell button as fast as their fingers could move, he said something completely different. He said this was not a crash. He said this was not the beginning of the end for gold and silver. He said this was a liquidation event, and he said it had a ceiling. Nobody wanted to hear that. Because when markets are falling hard and fast, the human brain does not want analysis. It wants an exit. It wants safety. It wants out. That is the moment when rational thinking becomes the rarest and most expensive thing in the world. And that is exactly the moment when this analyst chose to speak with complete calm. He identified 3 specific mechanical forces that were driving the sell-off. Not fear, not fundamentals, not a structural collapse in the precious metals market. 3 mechanical forces with hard end dates. Forces that were always going to stop. The question was never if they would stop. The question was when. The first force was the jobs report. A stronger than expected employment number had landed in the market like a hammer. It immediately triggered rate hike fears. Investors started pricing in a more aggressive Federal Reserve. That kind of fear moves money fast. It pulls capital out of gold, out of silver, out of any asset that does not pay interest. And it did exactly that. The second force was the CPI print. Inflation data came in at 4.2%. Hot. Hotter than Wall Street wanted. That number hit the market on Wednesday morning, and it accelerated the selling. Rate hike fears doubled down. The mainstream financial media had their headline and they ran with it. Bear market, gold collapsing, silver in free fall. The narrative was everywhere. But the analyst was watching a third force, one that almost nobody else in financial media was connecting to the metals market at all. SpaceX, the largest private company in American history, was preparing to go public. Its IPO was set to be the biggest in the history of United States capital markets, a $75 billion capital raise. To put that number in perspective, that is not a transaction. That is a financial event. That is the kind of money movement that reshapes portfolios, reallocates institutional capital, and creates mechanical selling pressure across multiple asset classes simultaneously. He explained it clearly. Institutions that wanted allocation in the SpaceX IPO needed cash. To get cash, they sold what they had. And one of the things they had, in very large quantities, was gold. $12 billion in institutional gold selling ran over the 2-week roadshow window leading up to the IPO. That is not a panic. That is not a loss of confidence in gold as an asset. That is a scheduled, mechanical, temporary reallocation of capital. And it had a hard end date. The moment the SpaceX order books closed, the selling pressure was finished. He told his audience this. He told them the ceiling on the selling was real. He told them when those three forces resolved, metals would recover, and he told them to hold. Most people in the financial media were not making that argument. They were reacting to price action. They were following the chart lower and calling it a trend. They were reading the fear in the market and feeding it back to their audience as analysis. That is not analysis, that is amplification. Real analysis requires understanding why prices are moving, not just where they are moving to. It requires separating mechanical events from structural events. A mechanical event is temporary. It has a cause, a duration, and an end. A structural event changes the underlying reality of an asset. The sell-off that hit gold and silver this week was mechanical from the first day to the last. Gold dropped to $4,022 per troy ounce, the lowest level since November 2025, a more than 6-month low. Silver fell to $61.59. The paper market was in full collapse mode, and still, he held his position. Not because he was stubborn, not because he was emotional about the trade, but because he had done the work before the storm arrived. He had identified the forces, he had calculated the ceiling, he had mapped the recovery trigger. He was not guessing, he was waiting. And what happened next would prove exactly why patience, grounded in real analysis, is the most powerful tool any investor can carry into a volatile market. There is a moment in every market cycle that separates the prepared from the unprepared. It does not announce itself. It does not send a warning. It simply arrives. And when it does, the people who did the work before it came are already positioned. The people who did not are left standing in the middle of the floor, watching numbers move, trying to understand something that is already happening too fast to catch. Friday, June 12, 2026 was that moment. And it did not arrive quietly. It arrived like 3 freight trains, running on the same track, hitting the same station, at the exact same time. Most market-moving events happen in sequence. One development shifts sentiment, then another follows days later, then a third emerges weeks after that. The market processes them one at a time. Investors adjust, positions rotate, narratives shift gradually. That is the normal rhythm of financial markets. But occasionally, and it is rare, multiple structural forces resolve simultaneously. When that happens, the market does not move gradually, it moves violently, and it moves in one direction with a speed and force that leaves analysts who were not prepared completely speechless. That is precisely what happened on Friday morning. The first train arrived from space. SpaceX, ticker SPCX, began trading on the NASDAQ exchange for the very first time. $135 per share, 555.56 million shares, a $75 billion raise, a $1.77 trillion valuation, the largest IPO in the history of United States capital markets, confirmed by Reuters. Not the largest technology IPO, not the largest IPO of the decade, the largest in the entire recorded history of American financial markets. The moment that opening bell rang for SPCX, something else happened simultaneously, something that most investors watching the SpaceX celebration never noticed. The institutional order books that had been open for 2 weeks, absorbing cash raised through gold liquidation, closed permanently. The $12 billion in institutional selling pressure that had been running over the roadshow window was finished. Done. Closed. The mechanical force that had dragged gold to a 6-month low evaporated in the same moment that SpaceX shares started trading. The selling was not going to come back, because the reason for the selling no longer existed. The second train arrived from the Middle East. Thursday evening, before Friday's open, President Donald Trump made an announcement that stopped markets mid-breath. The United States was canceling its planned third day of airstrikes on Iran, not postponing, canceling. He cited ongoing discussions being elevated to the highest levels of Iranian leadership. Then the announcement expanded further than anyone expected. Trump stated that the United States had concluded its conflict with Iran. Both sides were now evaluating a 14-point peace agreement. The Strait of Hormuz, one of the most strategically critical waterways on the planet, through which approximately 20% of the world's oil supply travels, was included in the discussions for reopening. Trump described the agreement in his own words as a very strong memorandum of understanding. He acknowledged it was conceptual, but the signal to markets was immediate and unmistakable. War premium, the invisible tax that conflict places on every asset class, began unwinding overnight. The third train was already in motion before most people woke up. Gold, which had hit $4,022 just the day before, opened Friday at $4,234.90. $212 of recovery in less than 24 hours. The biggest single-day gain gold had recorded since March. Silver opened at $67.49, up 5.5% from Thursday's close. From its cycle low of $61.59, silver had recovered 9.6% before most retail investors had finished their morning coffee. Three forces, resolved simultaneously, in less than 12 hours. Now here is where serious investors need to slow down and think carefully, because the natural human reaction to seeing these numbers is excitement, relief, validation, and those emotions, while understandable, are dangerous if they replace analysis at exactly the moment when analysis matters most. Because not everything about Friday was clean. Iran had not confirmed the deal. As of Friday morning, Tehran had not publicly ratified the 14-point agreement. The peace existed as a memorandum, described as conceptual by one side only. Markets were pricing in an optimistic outcome, but optimism and confirmation are two entirely different things. And in financial markets, the gap between the two is where corrections are born. The analyst made this point clearly and without hesitation. Gold was recovering because the market believed the deal would hold. But belief is not certainty. And if Iran rejected the terms over the weekend or introduced new conditions, the partial reversal early next week would be swift and sharp. He was not saying this to create fear. He was saying it because understanding exactly what the market is pricing is the only thing that protects a serious investor from being surprised by either outcome. The recovery was real, but the story was not finished, not even close. Markets celebrated on Friday. Investors exhaled. Portfolio screens turned green. Financial headlines shifted overnight from bear market warnings to recovery stories. The kind of whiplash that reminds every serious observer why following headlines is one of the most expensive habits a person can develop. But while the celebration was happening on the surface, something else was happening underneath it. Something quieter, something slower, something that does not show up on a trading screen or a news ticker. Something that has been building for months, ignored by mainstream financial media, misunderstood by retail investors, and completely invisible to anyone who has not been watching one specific set of numbers with serious attention: the COMEX vault data. Most investors have never heard of it. Most investors do not know it exists. And that gap in knowledge between those who understand what the vault data says and those who do not may be one of the most consequential information gaps in the precious metals market today. Here's what it means and why it matters. COMEX is the primary exchange where silver futures contracts are traded in the United States. When an investor buys a silver futures contract, they are not buying physical silver. They are buying a paper claim, a promise, a contractual obligation that says a specific quantity of silver will be available for delivery if the contract holder decides to demand it. That system works efficiently as long as the number of paper claims outstanding remains reasonably proportional to the amount of physical silver sitting in the registered vault available for delivery. As of Friday, June 12, 2026, those two numbers are not proportional. They are not even close. 275.3 million troy ounces of July silver paper claims are currently outstanding on the COMEX exchange. Against those claims, the registered deliverable vault holds 85.2 million troy ounces of physical silver. That produces a coverage ratio of 323.2%. In plain language, for every single registered troy ounce of physical silver that actually exists in the deliverable vault, there are 3.23 paper claims written against it. The COMEX data system has a specific label for this level of imbalance: extreme delivery pressure. Those are not the words of an analyst. Those are not the words of a commentator or a newsletter writer trying to create urgency. Those are the official words used by the exchange's own data system to describe what is currently sitting inside its own vault structure. And the clock is running. First notice day for the July silver contract is June 24th, 12 days away. That is the date when holders of July futures contracts must declare whether they intend to take physical delivery of silver or roll their position forward. When that day arrives, the paper claims and the physical reality must begin to reconcile. There is no mechanism that allows them to remain this far apart indefinitely. Something has to give. Now consider what happened to the registered vault this week during the crash. The paper price of silver fell from above $68 to $61.59, a significant, sharp, painful decline. Stop-loss cascades triggered through the 200-day moving average. Margin calls extended the selling. Institutional liquidation from the SpaceX capital raise added mechanical pressure on top of mechanical pressure. The paper market was in genuine distress. But the registered vault did not gain a single troy ounce, not one. While paper silver was being sold aggressively, while the price was collapsing on screens across the world, not a single additional troy ounce of physical silver entered the COMEX registered vault. The coverage ratio did not improve. The structural imbalance did not narrow. The 12-day clock did not pause. This is the detail that separates a paper event from a structural event. A paper event moves price. It creates volatility. It shakes investors out of positions. It generates headlines. But it does not change the underlying physical reality of the market. And the underlying physical reality of the silver market in June 2026 is that registered inventory has been draining consistently, month after month, at a pace that has no modern historical precedent. In January, the registered vault held 113 million troy ounces. By February, it had fallen below 100 million. Today, it sits at 85.2 million. Every single month in 2026, more physical silver has left that vault than the month before. The direction has not changed. The pace has not slowed. And nothing that happened in the paper market this week altered that trajectory by even a single ounce. Physical dealers told the same story from a different angle. When paper silver was crashing towards 61.59, premiums at physical dealers were widening. The people who hold and sell real, tangible silver were not panicking. They were not rushing to sell at the paper-generated discount. They were holding. Because the people closest to physical metal understood something the paper market was temporarily ignoring. The price on the screen was being driven by mechanical forces. The physical supply reality had not changed. That gap between the paper price and the physical premium is the most honest signal in the entire precious metals market. It does not lie. It does not follow narratives. It reflects what real buyers and real sellers of real metal are actually willing to do at any given moment. And on Wednesday and Thursday, that signal was saying one thing with complete clarity. The paper price is wrong. 12 days remain before that statement is tested at the highest possible level. The recovery happened. The numbers confirmed it. The analysis held. The three mechanical forces resolved exactly as predicted. Gold recovered $212 in less than 24 hours. Silver climbed 9.6% from its cycle low. SpaceX began trading. The Iran ceasefire announcement landed. Every variable the analyst had identified 3 days earlier played out on the same Friday morning with a precision that left very little room for coincidence. But serious investors do not celebrate recoveries. They study what comes next. And what comes next, in the 9 days following Friday, June 12th, is the most compressed sequence of high-impact economic events that the precious metals market has faced in all of 2026. 3 separate catalysts, 3 separate pressure points, each one capable of moving gold and silver significantly on its own, all 3 arriving within the same 9-day window. The first event opens Sunday and Monday. The G7 summit in France begins June 15th with 2 agenda items that carry direct consequences for gold and silver investors. Iran and Ukraine are both formally on the table. Every major world leader will be in the same room at the same time, with the Iran Memorandum of Understanding as the dominant conversation. If a formal agreement is confirmed during the summit, the war premium currently embedded in gold begins unwinding further. Prices could see a short-term pullback as geopolitical fear exits the market. But if Iran rejects the terms, introduces new conditions, or the talks collapse publicly on a world stage, the opposite occurs. Gold reprices higher immediately as conflict risk returns with full visibility. There is no neutral outcome from the G7. Every investor holding metals needs to understand which direction their position benefits from before that summit concludes. The second event arrives Tuesday and Wednesday. Kevin Warsh chairs his first Federal Open Market Committee meeting on June 16th and 17th. This is not a routine policy meeting. This is the first meeting under new Federal Reserve leadership with inflation still running at 4.2% and a jobs market that came in stronger than expected. Markets are currently pricing a 67% probability of a rate hike by December. What comes out of the policy statement on Wednesday will move gold and silver immediately and without hesitation. A hawkish tone, even without an actual rate hike, signals tighter financial conditions ahead. That pushes the dollar stronger. That creates headwinds for metals in the short term. A more measured or dovish tone signals the Fed is watching before acting. That removes a ceiling from the gold recovery and gives silver room to continue climbing toward the analyst cycle targets of $75 to $81. One statement, one press conference, immediate consequences for every metals position on the planet. The third event is the most structurally significant of all. June 24th, first notice day for the July silver contract. 12 days away as of Friday. 275.3 million troy ounces of paper claims, 85.2 million troy ounces of physical silver in the registered vault. A coverage ratio the exchange itself labels extreme delivery pressure. When first notice day arrives, paper and physical must begin reconciling. That reconciliation does not happen quietly. It happens through price. It happens through premiums. It happens through delivery demands that either get met or do not get met. And in a market where registered inventory has been falling every single month of 2026 without exception, the question of whether it gets met is not theoretical. It is the question. 3 events, 9 days, G7, FOMC, first notice day. Each one a catalyst. Together, they form the most consequential window for precious metals investors since this bull market began. The analyst who called the crash, identified the ceiling, predicted the recovery, and explained the mechanics before any of it reached mainstream headlines, is now watching all 3. Not with fear, not with excitement, with the same calm, prepared, evidence-based attention that made the original call possible. Because in markets, the work done before the event is the only work that counts. The 9 days have already begun.